Well, thanks a lot for that very generous introduction. It's a pleasure to be able to spend time in Rochester, and I would like to thank the Rochester Area Chamber of Commerce for arranging this speech and the other aspects of my visit. And I see my visit to Rochester as a great example of the kind of two-way communication that lies at the very heart of our Federal Reserve System. So you'll be hearing from me over the next 30 minutes or so. It may seem a little longer, but it will be about 30 minutes or so. And that kind of communication from policymaker to public is essential for good policymaking. Over the past 25 years, monetary policymakers all over the world, including here in the United States, have become more transparent about their deliberations and their thinking. And I think this is a very positive development, and speeches like this one that I'm about to give, I think play a huge role in that process of transparency. But that's communication in one direction. I think communication in the other direction, from public to policymaker, is also critical to good policymaking. Along those lines, I spent a morning listening and learning in meetings with business leaders, and I very much look forward to learning more from your questions following my talk. So as was mentioned in the introduction, I am the president of the Federal Reserve Bank of Minneapolis. And the Federal Reserve Bank of Minneapolis is one of 12 regional reserve banks that, along with the Board of Governors in Washington, D.C., make up the Federal Reserve System. Our bank represents the 9th of the 12 Federal Reserve districts, and our district includes Montana, North and South Dakota, Minnesota, northwestern Wisconsin, and the Upper Peninsula of Michigan. The Federal Open Market Committee, the FOMC, meets every 6 to 7 weeks, that's 8 times per year, to set the path of monetary policy. So all 12 of the presidents of the various regional reserve banks and the 7 governors of the Federal Reserve Board participate in these meetings. Now, I said there are 7 governors, but actually right now there are only 5. There are 2 vacant positions that are remain to be filled. But the actual policy decisions are made only by the committee itself. And the Federal Open Market Committee consists only of the governors, the president of the Federal Reserve Bank of New York, and a group of 4 other presidents, which changes annually. So currently, I'm a member of the committee, along with the presidents of the Federal Reserve Banks of Chicago, Dallas, and Philadelphia, but next year I will not be a member of the committee, although I'll continue to participate in the meetings. So the way the meetings work is that at each FOMC meeting, there are 2 what we call go-rounds, in which each president and every member of the board speaks in turn. The first go-round concerns current economic conditions and the economic outlook. The presidents typically say something about economic conditions in their own district, as well as talk about national economic conditions. The governors, as befits their national stature, speak about national economic conditions, although they often focus their remarks on particular slices of that overall economic picture. Now, in the second go-round, we each speak in turn about our views on the current monetary policy choices. Now, however, those discussions often range well beyond the confines of the next 6 to 7 weeks. There is no sensible way to talk about current policy choices without linking them in some fashion to future policy choices. Hence, meeting participants may sometimes describe, as briefly as they can, how they expect or would like policy to evolve over the coming months, or even, in fact, years. So my remarks today will be structured along the lines of an FOMC meeting. I will first discuss my outlook for the U.S. economy. I will then move on to talk about the key issues that I see affecting the FOMC's policy choices over the coming months and years. Now, before going further, I should say that my views are my own and not necessarily those of others in the Federal Reserve System or others in the FOMC. Now, those of you who read Fed speeches on an ongoing basis are very familiar with this disclaimer. It's an utterly standard one. But let me provide a little more detail about what it will mean about the remainder of my speech today. As I mentioned, I'm a member of the FOMC this year, and so I vote to determine the course of monetary policy at each meeting. Given my position, I believe that it is valuable for the public to know what economists would term my monetary policy reaction function. That is, my views about how monetary policy should react to various economic scenarios. Now, the FOMC is made up of 10 different individuals with 10 highly related, but nonetheless distinct, policy reaction functions. The ultimate reaction function of the FOMC, how it will react to various economic scenarios, is a collective reaction function, and it may well differ from that of any given committee member. And my remarks today are only about the nature of my reaction function and not the collective one of the FOMC. So with that context in place, let me move to my outlook. I'll focus on the three variables of most interest to us at the FOMC: real gross domestic product, GDP, unemployment, and inflation. My bottom line is that from the point of view of the macroeconomy, 2011 will be a better year than 2010. Now recently, last month, the Bureau of Economic Analysis released its advanced estimate for real GDP in the first quarter of 2011. By this estimate, real GDP grew at a 1.8% annual rate during the quarter. This growth rate is a bit slower than what we've seen since the end of the Great Recession. In the 7 quarters since June 2009, when the Great Recession is dated as having ended, real GDP growth has averaged just below 3%. This real rate of growth is slow compared with the recovery in real GDP that took place after the recession in 1981 to 82. However, it is similar to the recoveries that took place after the recessions of 91 and 2001. Now, despite this somewhat slow start, I do expect that real GDP growth will be slightly faster in 2011 than in 2010, something around 3%. But I have to say that given the depth of the recession that we've experienced, this rate of growth, around 3%, is disappointing. I do still see two headwinds in the U.S. economy. The first is that many households will continue to strive to rebuild their net worth positions in response to past and possibly future falls in residential land prices. As I've discussed on previous occasions, I believe that this decline in household net worth, precipitated by falls in land values, was a key factor in generating the severity of the Great Recession, and it will continue to remain important in the recovery. The second headwind is related. Many smaller banks in the United States face ongoing issues with asset quality. For example, the FDIC problem bank list contains over 800 banks. Problem banks are less likely to take the risk of lending to small and or young firms or to lend to other entrepreneurial activities. Instead, they are more likely to preserve capital ratios by limiting their asset growth and allocating their lending staff to working out loans to existing borrowers. Indeed, as the economy improves, as I predicted it will, I suspect this second headwind will actually become even more important. In 2010, our information at the Minneapolis Fed indicated that small businesses were reluctant to expand because of ongoing uncertainties about product demand. As a result, their demand for bank financing remained low. In 2011, as the economy improves, I expect loan demand to rise accordingly. But banks with poor asset quality will continue to focus on capital preservation rather than loan expansion. Let me turn now to the labor market, where I see conditions improving slowly. The unemployment rate has fallen from 9.8% in November to 9% in April. However, unemployment can fall in two ways. People can find jobs, or people can stop looking for work. Along these lines, it is worth keeping in mind that the employment to population ratio, the fraction of those over 16 with a job, has improved only slightly since November. This key variable remains near the quarter-century lows established in the Great Recession. I see the future course of unemployment as being shaped by two conflicting forces. On the one hand, the growing economy should generate more jobs and therefore lower unemployment. On the other hand, the growing economy will also lead more people without jobs to look for them. On net, I do expect the unemployment rate to normalize at close to 5% within the next 5 years. But the immediate progress will be slow. I expect that the unemployment rate will be above 8% and is likely to be close to 8.5% by the end of the year. So finally, I turn to inflation. The FOMC is mandated by the Federal Reserve Act to keep prices stable. This mandate is typically translated quantitatively into a 2% rate of inflation, or a bit under. Now, here by inflation, I'm referring to headline inflation. That is, the rate of price increase, a bundle of all consumer goods and services, including those related to food and energy. The problem is that monetary policy operates with relatively long lags. Hence, out of necessity, I view the committee's price stability mandate as requiring it to follow policies that will guide the economy toward 2% headline inflation over the next 3 to 4 years. And these lags are going to come up again when I talk about my policy, when I come to the policy just part of my talk, and so it's important to keep them in mind. I believe that the Fed can best achieve this medium-term objective for headline inflation, that's inflation of all the goods and services, by responding on an ongoing basis to movements in what's called core inflation. Now, core inflation is a measure of inflation that strips out food and energy products. I like core inflation as a measure of medium-term inflationary pressures, that's inflationary pressures over the next 3 to 4 years, because demand and supply conditions in food and energy markets are volatile. And so their prices tend to have relatively large transitory fluctuations. Responding aggressively to those fluctuations would lead to bad monetary policy. For example, increases in energy prices pushed headline personal consumption expenditure, PCE inflation, when measured over the preceding year, up to 4.5% in July of 2008. So in July 2008, headline inflation was 4.5%. The FOMC did not raise rates. And with hindsight, we can see that that was the right response to what proved to be a temporary increase in headline inflation. Now, from the fourth quarter of 2009 to the fourth quarter of 2010, core PC inflation, that's PC inflation without food and energy, was 0.8%. That's the lowest annual inflation rate in the 50-plus year history of that series. Inflation was low. But disinflationary pressures were still strong, because core PC inflation actually trended downward over the course of 2010. Over the last 6 months of 2010, annualized core PC inflation was actually 0.4%. That's the second lowest 6-month core PC inflation rate ever recorded. Now, as will become clearer as I continue my talk, I do not expect this kind of disinflationary pattern to continue in 2011. Core PC inflation from the fourth quarter of 2010 to the first quarter of 2011, so that one quarter, was 1.5% at an annualized rate. Similarly, I expect that core inflation will be 1.5% over the remainder of 2011. So let me summarize by my forecast then. I expect real output to grow slightly more rapidly in 2011 than in 2010. Household deleveraging and bank asset quality issues remain a drag on the recovery. Unemployment will fall, but more slowly than we would like. Finally, inflationary pressures are currently low, but I expect core PC inflation to grow slowly over the course of 2011 while remaining under 2%, which, as I talked about earlier, is the usual translation of the Fed's price stability mandate. Okay, so you listen to a bunch of forecasts. The interesting question is, what sort of faith should you put in those forecasts? Well, my history of making forecasts is short so far, because I only took over as president of the Federal Reserve Bank of Minneapolis in October of 2009, just over a year and a half ago. But in February of 2010, I gave my first speech as bank president, and I offered, just as I am today, forecasts about 2010 real GDP, unemployment, and inflation. And I have to say my forecast for unemployment and GDP ended up being pretty accurate. But my forecast for 2010 headline and core inflation were both about a percentage point too high. So the low core inflation and the low headline inflation that we experienced in 2010 was a surprise to me relative to where we stood at the beginning of 2010. I encourage you to keep this forecasting error in mind as I move on to what would be the second go-round in the FOMC, the discussion of policy considerations. I'll first discuss where we are now and then talk about possible monetary policy changes over the coming year. Just as is true in many FOMC policy go-rounds, you will see that my discussion will necessarily spill into choices and decisions to be made over the next 5 years. So where are we now? The Federal Reserve currently has two forms of accommodative monetary policy in place. The first is the FOMC is targeting a low Fed funds rate of between 0 and 25 basis points. This kind of accommodation, keeping short-term rates low, is an entirely conventional response to unduly low levels of core inflation and unduly high levels of unemployment. By keeping market interest rates low, the policy encourages companies to invest their resources into hiring and business expansion, and also encourages households to engage in more spending. The second kind of accommodation is less conventional. The Fed has bought about $2.1 trillion of longer-term government securities. And the FOMC has committed itself to buying an additional $200 billion of these securities by the end of June. The thinking behind this form of accommodation is that the FOMC's holdings of $2.3 trillion of long-term securities raises their prices. Taking the stock of this off the market raises the prices of those that remain within the market. And by raising the prices of long-term securities, you're lowering the yields of long-term securities. By doing that, more long-term investments, like building factories, hiring workers, become more attractive to business. Together, the low Fed funds rate and the holdings of long-term government securities provide a formidable amount of monetary policy accommodation. We can quantify their joint effect using results in a recent research paper by Federal Reserve research staff. That paper estimates that if the Fed buys $200 billion worth of long-term government securities, the Fed provides stimulus to the economy that's equivalent to that achieved by lowering the Fed funds rate by 25 basis points. So buy $200 billion, it's like cutting the Fed funds rate 25 basis points. This translation implies that at the end of 2010, the FOMC's total amount of monetary accommodation was roughly equivalent to what it could have achieved by maintaining a Fed funds rate of negative 2.5 percentage points. So we couldn't literally do that. You can't make the Fed funds rate actually go below zero. But by combining the low Fed funds rate with the purchases of the securities, it was as if we were providing stimulus equivalent to negative 2.5 percentage points. Now, this level of accommodation was adopted in November of 2010, when the FOMC committed itself to buying $600 billion of longer-term treasuries by June of 2011, a date we're now approaching. The decision of the committee was nearly unanimous. I was not a voting member at that point last year, but I did support the decision. We had seen a rather sharp fall in core inflation over the course of 2010 compared with what we had seen in 2009 and compared with what I had expected earlier in 2010. And I believe that it was appropriate to ease policy in response to this fall in inflation. Now, for myself, I would have greatly preferred to have been able to cut the Fed funds rate, but that just wasn't an option because the Fed funds rate was so low already. Now, notice that the FOMC could have chosen a greater degree of accommodation by buying more long-term treasuries, or it could have chosen a smaller degree of accommodation by buying fewer long-term treasuries. My conclusion is that in late 2010, this level of accommodation was neither too tight nor too loose, given the prevailing economic conditions at that point in time. But conditions change, and monetary policy must adjust to those changes. Now, the next sentence in my speech is the most scary one. Whenever you hear an economist utter the following phrase, here's a metaphor that may be helpful. That's a time to be afraid. So when I was in graduate school, I remember when my professors would be doing some kind of abstract math and all this stuff on the board, and then they would say, here's a metaphor that may be helpful. Then they would start launching a long discussion of yams and coconuts, and it was never that helpful. But with all that said, I'm going to forge on with my own metaphor. So we can think about the level of monetary accommodation as being akin to a gas pedal on a car. And the Fed's dual mandate, maximum employment, price stability, is being a target speed that we're trying to hit. And right now the car is going too slowly. So the Fed has its foot on the accelerator. So that's a nice enough metaphor. But there's a tricky problem with it. With a driver can just keep his foot on the gas until he hits his target speed, and then take your foot off. Monetary policy doesn't work like that. It operates with long and variable lags. It's like driving a car in which the car's rate of acceleration responds 10 to 20 seconds, you're not sure which, after the driver adjusts the gas pedal. So a driver of that kind of car is going to have to ease up on the gas as he gets closer to his target speed, or he will inevitably overshoot that target speed. So in the same way, the Fed has to lower its level of accommodation as it gets closer to fulfilling its price and employment mandates. Now, like driving, monetary policy is an exercise in scenario analysis. If the car were to start going uphill and its speed were to falter, the driver, of course, has to put more pressure on the gas. Similarly, if the economy were to move further from the Fed's dual mandate over the course of 2011, then the FOMC would need to put more pressure on the monetary gas pedal and increase the level of its accommodation. So when I engage in monetary policy scenario analysis, I find it useful to start, but not finish, with my baseline economic forecast. When the FOMC adopted its current level of accommodation in late 2010, year-over-year core Pce inflation, as I mentioned earlier, was 0.8%. My baseline forecast is that by the end of 2011, core Pce inflation will be 1.5%. That is 70 basis points higher than in the prior year. The Fed would not be beyond its price stability mandate of 2%, but it would have gotten closer. And so it should ease the pressure on the monetary gas pedal. Now, my recommendation in this scenario would be to raise the target Fed funds rate by 50 basis points. Now, how do I get to 50 basis points? Why not a smaller or a larger figure? So I'll tell you about three elements that enter into my calculation. First, the standard response to a 70 basis point increase in core inflation would be to raise the target interest rate by a larger amount. That is, by at least 70 basis points. For example, the widely known rules associated with John Taylor of Stanford University would recommend that the response would be to raise the target interest rate by 1.5 times the observed increase in core inflation. So that gets us up to 105 basis points, 70 times 1.5. Now, monetary policy should also adjust in response to changes in labor market slack. Now, these changes are very hard to measure, but like many other economists' forecasts, my baseline forecast is that unemployment will be at least 1 percentage point lower at the end of 2011 relative to November 2010. Remember, in November 2010, unemployment was at 9.8%. So I am expecting unemployment to be at least a percentage point lower by the end of 2011. Now, this kind of fall in the unemployment rate would generally be viewed as signaling a decline in slack, as would the increase that I expect to see in core inflation. This fall in labor market slack would argue in favor of raising the Fed funds rate by even more than the 105 basis points that I mentioned earlier. Now, so far, these two elements I've mentioned, the increase in core inflation and the decline in labor market slack, imply that the target Fed funds rate should be raised by at least a percentage point. But there's a third effect that partially offsets the first two. The level of accommodation provided by the Fed's holdings of these long-term securities depends on how long people expect those holdings to last. I'll take an extreme. If the Fed were expected to sell all of its securities tomorrow, these holdings would no longer provide any noticeable downward pressure on long-term interest rates. Now, The Fed is not going to sell securities tomorrow. But at the end of 2011, we are presumably 1 year closer to the eventual normalization of the Fed's balance sheet than we were at the end of 2010. And the staff research paper that I mentioned estimates the reduction in accommodation to be roughly equivalent to a 50 basis point increase in the Fed funds rate. So because we're 1 year closer to whenever the normalization date is, as long as people haven't moved that forward in their thinking, that's basically equivalent to a 50 basis point increase in the Fed funds rate. So I take 105, subtract 50, get around 50. That's how I got to my number. So if PCE and core inflation rises to 1.5% over the course of 2011, the FOMC should raise the Fed funds rate by around 50 basis points. Now, a core inflation rate of 1.5% is still noticeably below the Fed's price stability objective of 2%. Accordingly, an increase of 50 basis points in the Fed funds rate would still leave the Fed in a highly accommodative stance. First, the Fed funds rate would be extremely low, between 50 and 75 basis points. As well, the Fed would still have holdings of long-term assets that would continue to provide significant accommodation. Using estimates from the staff research I mentioned earlier, we can combine the two forms of accommodation, low Fed funds rate, 50 to 75 basis points, and the holdings of securities. It would be roughly equivalent to maintaining a Fed funds target interest rate of negative 1.5 percentage points. I think you can only describe such a stance as easy monetary policy, just not as easy as the end of 2010. So under my baseline forecast, it would be desirable for the FOMC to raise the Fed funds target interest rate by a modest amount toward the end of 2011. Now, the FOMC could reduce accommodation in another way, by shrinking the balance sheet, shrinking the Fed's holdings of long-term government securities. Now, this reduction could take place in one of two ways. First, the FOMC is currently investing any principal payments from its securities holdings into long-term treasuries. So if a security matures, the Fed takes that money and reinvests it into long-term treasuries. The committee could decide to stop all or part of these reinvestments. This would provide a very modest reduction in accommodation. Alternatively, the committee could reduce accommodation by choosing to sell some long-term assets. So these two approaches operate by reducing accommodation by operating the Fed's balance sheet, and I'm open to them. I'm open to these approaches of reducing accommodation. But based on what I know now, I would prefer to reduce accommodation primarily by raising the Fed funds target interest rate. I have more confidence in that instrument of policy based on our many years of experience with it. And I suspect that this confidence is shared by the public at large. Now, I want to be clear. The Fed does need to shrink its large balance sheet. But I see that as a longer-term mission that can take place over the next 5 or 6 years. And I believe this mission should be guided by two key principles. First, the Fed should commit itself to a path of shrinkage of its asset holdings. Second, that path should be sufficiently gradual that will interact little with the effectiveness of monetary policy. So I think it's important for the FOMC to offer as much certainty as possible about the rate of shrinkage. Now, I've been describing how monetary policy should react to one particular scenario, my baseline forecast. As I noted, my baseline forecast on inflation was wrong last year. It could be wrong again this year. As a policymaker, I need to be prepared for that possibility. In terms of inflation, there are two possible kinds of errors that could take place. On the one hand, my forecast for core Pce inflation might be too high. If core Pce inflation were to fall over the course of 2011 relative to 2010, then it would be desirable for the FOMC to ease further in response to that decline. And I imagine that easing would take place through the purchase of more long-term government securities. On the other hand, my forecast for core Pce inflation might be too low. For example, core Pce inflation might rise to 1.8% over the course of 2011. The FOMC should respond to evidence of such a large increase in inflation by raising the target Fed funds rate even more aggressively than I have suggested, and I would recommend doing it sooner than I've suggested as well. So let me wrap up. My goal today has been to lay out my outlook for the economy and give you a sketch of how I believe monetary policy should react to changes in economic conditions. Under my baseline forecast, I believe that it would be appropriate for the FOMC to raise the Fed funds target interest rate by a modest amount at the end of 2011. However, that forecast, like all forecasts, is subject to error. And I've also discussed how my policy choices should and would react to those errors. That is, I've talked about my policy reaction function. So I began this speech by broadly describing the makeup of the Federal Reserve System and its policy-making body, the Federal Open Market Committee, as well as my role on that committee. So I come back to that at the end. I want to underscore the independent, yet collaborative nature of the FOMC. As I described, each member of the FOMC has his or her own policy reaction function, grounded in our distinct but related views. I believe it is a responsibility to describe those different views to the public. In that respect, I hope you found this speech enlightening, and I'm happy to take your questions to provide fuller explanation on these and anything else that might occur to you. Thanks again.